Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day, which comes from Dave, who wants to know if he should sell a stock that's gone down in value since he entered his covered call writing trade. Alan, I've been virtual trading on the CBOE site as you suggested. Of my first 3 trades, I have one losing position and want to know if I should sell the stock LVS. Please see the screenshot below. Thanks, Dave. All right, Dave, let's have a look at the screenshot. Let's get right into it and evaluate it and see whether or not it makes sense to sell the stock or if you have any other choices. In the screenshot that you could see now in front of you, we could evaluate Dave's trade. He bought 100 shares of LVS on the upper left side there for $77.03 and sold the near-the-money 77 strike for $204. Now, in the middle of the screenshot, you could see that the current market value of the stock was $74.45. And then all the way over to the right, that little note that Dave made, it says, should I sell it? Well, let's figure it out initially and see where Dave stands if he does sell the stock. He purchased it for $77.03 and would sell it for $74.45, and that would result in a debit or loss of $258 per contract. Now, he generated an initial option profit of $204, and he would have to buy that option back before selling the stock, and as you'll see in a moment, that would cost him 21 cents. So the actual option credit would be $1.83. So net-net, if he closes his position, there'd be a loss of $75 for the contract. So the question is that a step that Dave should take, or is there another choice? Well, in my books and DVDs, you know that I talk about the rolling down exit strategy in the first part of a contract. And that is also something that could be used in the second part of a contract as well. So the question is, should Dave close his position and sell the stock, or should he consider rolling down? And so in order to figure that out, we have to access an options chain. And so let's have a look at an options chain on the very day that Dave sent me the screenshot and asked the question. And here you could see that I've highlighted 2 strike prices. The first one was the 77 strike, which Dave originally sold. And you could see the ask column for that particular strike is 21 cents, as I mentioned before, to buy back the option. And the 74 strike is generating $1.19 in the bid column. So if Dave were to sell the 74 strike, he would generate $1.19. So it would cost 21 cents to buy back the original option and $1.19 to sell the 74 strike. Now, the 74 strike is actually in the money because the current market value of the stock, if you recall from the screenshot we just showed you before, was $74.45. So this is actually in the money. So now what we have to do is kind of take a look, see what our option credits are, and take a look at the share loss and figure everything out. So in the next screenshot, you could see we're going to first calculate our option credits. Well, 204 was the credit for selling the original option. 119 would be the credit for selling the 74 or rolling down. 21 cents is the debit for buying back the 77 call. Net, we have a total option credit of 302 if we roll down to the 74 strike. Now, the share loss is from 77.03 down to the new strike, not to 74.45, because now we're agreeing to sell our shares for 74. So our share loss is then 303. If we compare that to the option credit of 302, we basically have a wash situation or a no loss situation. Now, if the price of the stock should drop 45 cents down to the 74 strike, we still have a wash, a no loss situation. But if it drops below 74, we would then start to lose money, and that's when we would again reevaluate selling the stock or rolling down a second time. So basically, Dave, you have two choices. If you sell the stock right now, you would lose $75 a contract. If you would roll down to the 74 strike, you would be in a no-lose situation, and you would have a little wiggle room from 74.45 down to 74 if the price of the stock declines a little bit more. And if it doesn't and continues to decline even more than that, you could once again roll down or sell the stock. You could reevaluate it. So take a look at all of your choices and select the one that you feel is best at that point in time. So for more information on the rolling down exit strategy, which is one that all covered call writers should master, if you have the complete encyclopedia for covered call writing, I suggest you review pages 256 to 259. And if you have either one of my DVD programs, we devote a lot of time to the rolling down exit strategy in both of those programs. So Dave, I hope I've answered your question adequately, and I thank you for that. And of course, thanks very much to everybody out there for taking the time to watch this video. I hope you found it useful. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.